We will begin in the next 2 to 3 minutes. Thank you so much. Okay. Good evening, everyone. Can someone quickly on the chat window say yes if I am clearly audible? Uh, yes, great. Okay, thank you so much. Thank you. So, welcome to today's session on understanding valuations. As a startup founder, this is one of the most important topic. How do we value our business? If you are going to raise capital for your venture, you need to understand what are the ways in which you can actually value your business. And this is precisely what we are going to actually talk in today's session. And you will exactly know how do we value your startup. Quick background about myself. My name is Vikrant. I am the co-founder of FundEnable Toolkit and Indian Academy of Venture Capital. Uh, I run an investment bank along with my co-founders, which is predominantly into raising capital for early stage ventures. So far, I have personally helped companies in raising upwards of 200 crores of capital. We work closely with incubation centers across the country and building capability and helping founders in raising a round of funding. I'm a speaker on a show called Startup Nation on CNBC Avaz. And over the weekends, in my free time, I teach at various business schools like SPJMR, XLRI, IIM Ahmedabad, CII, Exceed XLRI, BSc Institute, etc. So that is what I teach. I teach entrepreneurial finance and venture capital. Today's session, guys, is going to be all about understanding how do we value our startups, how do we value our early stage businesses, and the techniques used. The way we value is very, very different from a large scale company, from a normal company, from whatever you've heard or read about in books of finance in terms of valuation. Things are very different when it comes to startup valuations, right? So, what exactly do we mean by valuation? And let's start with that. The simple answer to this is valuation is nothing but 100% worth of your business. So you have, you have shares in your company, right? If you've created a private limited company, you would have X number of shares. Now, what is the value of all the shares? What is the value of 100% worth of your company? Is essentially what we call as valuation. So always remember this. This definition is going to be handy when we get into Excel calculations tonight. But just to tell you, valuation is nothing but 100% worth of your business at any particular point in time. Now, how do we go about finding valuations? What are the ways? What are the methods that you actually use to value your startup? And you would have heard of a method called as a discounted cash flow method. So if you read books of finance, if you've studied finance, there is this classic method for calculating valuation of an asset, and that method is called as discounted cash flow method. Uh, unfortunately for us, startups cannot be valued, or it is very difficult to value startups using discounted cash flow method. This method, guys, is very good for large businesses, for stable businesses, for old businesses who have operating history, who have stable cash flow. You know, the method in itself, discounted cash flow method, what does it do? It actually captures or discounts the future cash flow which your business is going to make. And when I say future cash flow, it is very different from revenue, it is very different from profit. Cash flow, right? What is the cash flow that your business is going to make? Discount it to today, and whatever will be the value is what is the value of the business today. However, startups cannot be valued using this method. Why can't startups be typically valued using discounted cash flow method? Is because initial years, Forget about profit. We do not have, we do not have free cash flows. If we had free cash flows, if we had a lot of cash getting churned through our venture, we would never have approached investors, or we would have not raised a round of capital, right? Initially, your cash is getting deployed into expansion of business. Your cash flows are getting utilized in expansion of business. And that is the reason why there is no or very little cash, right? Most startups in the initial few years, forget about, excuse me, forget about, profits. They will be loss making. They will have EBITDA level losses as well. And therefore, guys, discounted cash flow method cannot be typically used for valuing startups, right? Now, if DCF cannot be used, and DCF is a method for large, stable cash flow businesses, what is the method that we should use while valuing our startups? What are the kind of methods that we should use for valuing startups? And one such method, which I'm going to take you through today in detail, is basically called as transaction comparable method. Now, this method, guys, is widely used method for capturing or for calculating the valuation of an early stage business or a startup, right? What we call it is transaction comparable method. So I'm going to request you to write down a few things, right, through this session, because then we are going to revisit these things at the end of the session. So first thing that I want you guys to write down is just write this transaction comparable method. Now, what exactly is transaction comparable method and how is it actually used? So let's say, you are going out for grocery shopping, and say you are going out to shop vegetables, right? And you want to buy potatoes. Say, for example, you want to buy potatoes. You go to a vendor and you ask him that how much does 1 kg of potato cost? भाई साहब आलू का 1 किलो का भाव कितना है? The vendor will go and tell you that आलू का भाव 35 रुपया किलो है. Now, what is the way in which you can actually validate? How do you make sure that the price of 1 kg potato is actually 35 rupees per kg or not? How do you actually, validate that, right? What is the way in which you can validate it? A very simple way to validate it, as mentioned by Sumit on the chat window, is just go to another shop, just go to another vendor and check with him. If he also comes back and says that, yes, the cost of buying 1 kg potato is 35 rupees, then we can be sure of the fact that potatoes in market as on today cost 35 rupees per kg. Transaction comparable method, guys, is very similar to what we just discussed. And listen to this, what I'm saying, right? To value our startup, what we are going to do is we are going to find the valuation of businesses or business models that are similar to our company. Okay, so what is it that we are going to do? To figure out, what can be our valuation. We are going to first find the valuation of similar businesses or similar business models. Using that, we are going to draw certain inferences. After studying valuations of similar businesses, we are going to draw certain inferences. And these inferences we are going to apply to our venture to find out the valuation of our company, right? So we've studied the valuation of similar businesses. We are going to now draw certain inferences from that. Once we draw those inferences, we are going to apply those on our venture and we are going to find the valuation of our business. And this is what transaction comparable method is all about, right? What we are going to do, guys, is in 6 simple steps, in 6 easy steps, I'm going to take you through valuation. And we can now, after that, you can do valuation. You can find valuation of your businesses as we speak, as of now. To take you through these 6 steps, I have a a business for you called Terraman. Now, Terraman is a men's grooming company, right? What it does is it sells products which are related to men's grooming, right? This company was founded by Rohan and John somewhere last year in April 2019. And what the company actually does is it sells things like shaving foam, beard wax, face wash, body wash, everything which is required for men's grooming, specifically for men's grooming. This company sells that through only online channel, right? So what they do is they actually use websites like Amazon, Flipkart, Nika, their own website, etc., to reach out or to drive sales. So this is an online only strategy for an FMCG brand, which is precisely made to only cater to men when it comes to their grooming needs. And that is what the company does. Now, as we speak, at this point in time, 1 year post the operation, so the company was set back in April 2019. 1 year post operations, where are we? The company has actually done a revenue of 1 crore. So in March 2019, in March 2020, April 2019, the company started. In March 2020, 1 year when it was completed, the company made a revenue of 1 crore, right? So just write down somewhere that this company made a revenue of 1 crore in the last year. Now, what this company is trying to do is, this company is saying that, if we actually, if we actually go ahead and actually start doing business this year, we will easily be doing a revenue of around 10 crores. From 1 crore, there is a potential. We have received great response. There is a potential to kind of take my company to current 1 crore to a 10 crore level. But there are going to be certain things which are going to be required to take the revenue from 1 crore to 10 crore. And what are those things required for taking the company from 1 crore to 10 crore? Very simple and very logical things, guys. First is the company will have to develop new products because they will have to stock inventory. Second thing is they have to aggressively market these products through digital channels like Instagram, Facebook, etc. And third thing, the most important pillar of any growth plan is they need to hire the right set of talent, the right kind of people with the right background to help them scale their venture. And this is what the company is going to require as a part of their expansion initiatives to take the revenue from 1 crore to 10 crore. And obviously, at the base of all of this, obviously, for making this thing precisely happen, what this company needs is this company requires a capital infusion, a first round of funding of 3 crores. So the plan of Rohan and John is that, we can take the company from 1 crore to 10 crore this year by developing new products and stocking inventory, by aggressively marketing on digital platforms, and by hiring people. But for making these three things possible, I need a capital infusion of 3 crores. So that is what precisely the company is wanting to do. Now, obviously, the company is reaching out to investors. And while they have reached out to investors, there is one investor called Lion Capital who has agreed, or who is a specialized FMCG investor, invest in FMCG brands. That is something which they want to kind of back. Lion Capital wants to back Terraman by investing 3 crores. They are confident that this company will go to the next level. And they are saying that, hey, you know what? We are interested to invest in your business. But the question that they are asking the founder is that, how much are you willing to give us as ownership in the business? What is the value? What is the percentage stake that you want or you want to give us as founders for investing 3 crores? Rohan and John communicate to them that, you know what, we will be willing to invest 10 crores in this business. We will be willing to give you 10% stake of the business, right? So what Rohan and John are saying that you invest 3 crores in our company, and against that 3 crores, we will give you 10% stake in our venture. Now, Ron and John does not have any basis for this. Okay, they are just thinking that, oh, you know what, we are comfortable with a 10% stake or a 10% dilution, and therefore we will go ahead and do 10% stake dilution against 3 crores. But they don't have any logic. They have no idea how to go about it. But effectively, if you see, what they are asking is, when Lion Capital starts analyzing this transaction, which is on the table, that 3 crores 10%, what they actually get to know is that let's find what is 100% value, because valuation at the end of the day is 100% worth of the company, right? So if 3 crores के लिए 10% है, तो 100% of the company is how much? So this is a simple fourth grade cross multiplication that we have to do. If 3 crores means 10%, what means 100%? And if you do cross multiplication, as it is seen on the screen, you will realize that what Rohan and John are actually wanting, are actually looking at, is a valuation of 30 crores. This is what the ask is. This is what the founders are wanting from the investor. There is no basis, but effectively now, if we see what is the deal on the table, is that Rohan and John want to raise 3 crores of funding for expansion of Terraman. Against this 3 crore of capital infusion, Rohan and John are willing to give 10% stake to the investor, thereby valuing Terraman at 30 crores. Now, this is what the situation is. Obviously, guys, Lion Capital, a venture capital investor, is not going to take this deal on face value. They have to verify, they have to actually figure out, they have to find that really Terraman is valued at 30 crores. Is it valued at 30 crores? Is it valued? What is the valuation? How do we go about verifying that? And this is where I want you to think about the potato story, the grocery buying experience, where now what we are going to do is we are going to get into transaction comparable method to actually figure out mathematically what should be the valuation of Terraman at this stage using the transaction comparable method. So the first step, guys, in transaction comparable method, and my request to all of you is to make a note of steps. Step 1, finding comparable companies. Please make a note of it, and then we are going to revisit it, right? So the first note that we made was valuation is 100% worth of the business. Then the second note that we made was transaction comparable method is the right approach to actually raise or value startups. The third note that you're going to make is step 1 of transaction comparable method is finding comparable companies, right? Finding comparable companies where an investor has actually invested in that particular business. So while finding comparables, what do? We look at similar funded companies. If you are the first mover in a particular sector, we look at similar business models. Even though you might not have similar companies, you should look at similar business models. I will elaborate that further, right? Obviously, same sector, similar size, same round of funding. If you are raising the first round, you should look at the valuation and you should study companies who have raised their first round, right? So simple question, if you guys are aware of this men's grooming segment, very similar to Terraman, can you think of businesses which are similar to Terraman? Can you think of comparables? Can you think of companies which are similar to actually Terraman? Any idea? Any thoughts? Have you come across? Yes, Beardo is one example. The Man Company is another example. Precisely, all of you guys. Ustra, very right. Ustra is one example. And These are the comparables for our business. You can see in front of your screen, there are four major comparables in terms of, Beardo, the Man Company, Bombay Shaving Company, Ustra. These are the businesses in which some venture capital investor has invested money, and these businesses have raised a round of funding, and using this round of funding effectively, these guys have expanded. But the first step that we had was to find comparables, right? And four comparables we have figured out. Now, what I'm going to do is, first step is check. First step is done. What we've done is finding similar businesses where venture capital investors have invested money. And in all these four companies, VC investors have actually invested capital, right? Uh, let's now move on to the second step, and please make a note of it. We have to now find valuation of these companies. When a particular investor invested in these businesses, how much was the valuation given to these businesses by the investor? At what value did the transaction happen? And that is the second step, guys, that we need to find out through this entire exercise and through the second step. So step two of our 6 steps on raising on finding valuation of your company is finding the transaction related data. Now, what exactly are we going to find? Ask 4 questions. Okay, these 4 questions are important while you find the transaction related data for each of these comparables. Question number 1, who invested? Investor का नाम क्या है? Question number 2, when did the investor invest in these businesses? You know, when was it? What year, what month, right? Third, how much was the investment amount? कितना पैसा रेज किया था? And fourth, against that investment amount, how much stake was given to the investor? Very simple 4 questions. Whenever you look at any investment opportunity or any investment news, try and find these 4 answers to these 4 questions. Who invested? When did the investment happen? How much was the investment amount? And against this investment amount, how much stake did the investor actually buy, right? These are the 4 questions. The answers to these 4 questions, guys, I have actually noted in an Excel sheet, and this is how the Excel sheet looks like, right? I'm going to take you through it. So step 1 in the Excel, I've just mentioned the list of investors, right? That was step 1, which I've put in the Excel. And now we're going to get into some hardcore calculations, guys. Step 2 is we're going to find deal related data. So let's take an example. Consider Beardo, right? In Beardo, who invested? Venture Catalysts is a group of investors that invested. When did the investment happen? The investment happened in the year 2016. How much was the deal value? How much was the deal value? How much was the investment amount? The investment amount was 3.3 crores. How much stake did Venture Catalyst take in Beardo against an investment of 3.3 crores? These are the 4 data points that we've found. So who invested? Venture Catalyst. When? 2016. How much? 3.3 crores. And what was the percentage stake? It is somewhere around 49% stake, right? Now, this last 2 points which we are seeing, point E and point F, just focus on column E and column F. What have I actually found out? I have actually found out the valuation of these companies, because if I know who invested, how much was the investment amount, and what stake, by doing simple cross multiplication, I can find 100% value of the company, which means I can find valuation of the business. And therefore, the outcome of step 2 is actually finding valuation for each of these companies, right? So if you look at Man Company, Redcliffe Capital in 2017 invested 3.3 crores for a 20% stake, thereby valuing the Man Company at 16.5 crores. And this is what we have found out in step 2. Now I'm getting a lot of questions on the chat window that how will we get this information? From where are we going to actually get this, right? Now, guys, this information, like you have rightly pointed out, like you have rightly said, this information typically is not freely available. People will, companies will disclose, who invested, how much was the investment amount, that they will disclose. But how much stake, that they will not disclose typically. But guys, but regulatory, from a regulatory standpoint, you have to disclose the deal related data on a portal called ROC, which is maintained by Ministry of Corporate Affairs, right? So ROC is all your private limited companies. If you might be running private limited companies, every time you do filings with ROC. Similarly, when you are raising a round of capital, you are actually filing it with ROC. Our private limited companies are regulated by Ministry of Corporate Affairs, right? MCA. And MCA has this portal called Registrar of Company. Whenever you raise a round of funding, whenever you alter your shareholding structure, whenever you are increasing the authorized capital of your company, you have to mandatorily disclose, you have to compulsorily go for actually filing this data on the ROC website. Now, what we do is we go to the ROC website, we pay some fee, and we download the company details. But believe me, guys, this is a very difficult task. It is not that easy that you go to ROC, because you need to read in between lines and read the documents, understand these documents, which have a lot of jargons, to fish or to kind of pull out this information, right? And therefore, the other alternative for this is there are certain paid or subscription based databases that you can access and you can get this information from. However, the challenge there is that these databases are also very expensive. They are not very cheap. These are very expensive databases. We at FundEnable have addressed this problem of helping you on finding the right comparables, on finding the right deal related data for you through the FundEnable toolkit. I'll talk about it at the end. But these are the ways. Typically databases or Ministry of Corporate Affairs are legit sources, are important sources from where you can download the data. Advantage of MCA, it is cheap, but disadvantage of MCA is that it is very difficult to maneuver through the information. Advantage of databases, gives you data in a structured format. Disadvantage of databases, very, very expensive, 60,000-70,000 rupees you have to kind of pay, right? So we have kind of figured out a way to help you to actually give this information to you in a very structured format through the FundEnable toolkit. I'll talk about it at the end. For now, just understand step 2. Step 2, we have found out deal related data, right? This is what we have found out. Step 3 is what we are going to essentially do in step 3. And I'm going to move back to our PPT. So step 3 actually is, like we discussed, the outcome of step 2 is valuation of the businesses. Step 3 is a very tricky step, and please concentrate on this step. This is possibly the most important step, and then we are through. Then we will be able to easily calculate the valuation of our business, right? what we have to do is we have to find the next year revenue, right? Make a note of this. What do I mean by that? The year in which the deal happened. Listen to this. The year in which the deal happened, the year in which the company raised money, what was the revenue of the company 1 year later? What was the revenue of the company 1 year post the investment? So, what we are trying to figure out is the impact of investment on the next year revenue. If a particular company raised 3.5 crore rupees of capital in 2016, how much was the revenue of the company in 2017? And this is what this is precisely what we are trying to find out in this step, which is possibly the most important step in transaction comparable method. Let me go back to the Excel sheet and let me quickly tell you what do I mean by that, right? What we have said here is in Beardo, just look at the Excel. In Beardo, Venture Catalyst invested in 2016. In 2017, and now focus on column H. Focus on column H. In 2017, 1 year later, the revenue, the total amount of money that Beardo made, the sales of the company was 8.4 crores. So, जिस साल में इन्वेस्टमेंट हुआ उसके अगले साल कंपनी का रेवेन्यू कितना था? In 2016 the investment happened. In 2017 the revenue of Beardo was 8.4 crores. This is what we have actually found out, guys, right? Now for every company we have to find this information. Again, the question is, where will you find this information? The same databases, the same register of company that we spoke about, every particular business has to mandatorily file these numbers with ROC, and you have to pay a small fee to download the filings of any company, private limited company, which is there. So, a lot of people have this notion that when it comes to private limited companies, the data is not available. That is not true. By paying a small fee, the data is available. Unlike listed companies where they have to mandatorily put it out on their websites, right? That is not the case in case of unlisted companies. They don't have to put it out on the website, but what they have to do is they have to file it with ROC, and that data can be downloaded by us by paying fee. Again, difficult to maneuver. The databases, expensive. FundEnable is there to kind of help you in this particular exercise, right? So step 3, guys, was finding 1 year forward revenue of the business. Guys, I'm just going to take a brief moment of silence. I want you to actually understand what we have done till now. From your notes, just go through the first 3 steps. Simple. They are very, very simple. Just go through the first 3 steps. We'll take a brief moment of silence. If you have not understood any step, please just mention it on the chat window, and I will revisit that at the end. But right now, just go through it. Quick moment of silence. Okay, so if now you guys have gone through the 3 steps, let's go to the 4th step, and it is very, very simple step. The 4th step is what we call as finding the revenue multiple. So write down the 4th step as finding revenue multiple, and you would have heard this term called revenue multiple. Now, what is revenue multiple? Let's try and understand. Revenue multiple is nothing but valuation which is column G, divided by the next year revenue of the company, which is column H. Very, very simple. Revenue multiple is valuation divided by the next year revenue, 1 year forward revenue. So 100% value of the company divided by what the company did 1 year post investment is what we call as the revenue multiple. You would have heard in news, this company raised money from this fund. The deal happened at a revenue multiple of 4 times, or e-commerce companies raised money at 2 times the gross merchandise value, etc., etc. So these are the benchmarks, guys, that are used to value businesses. In startups, what is the most famous benchmark is revenue multiple. Just the way we have revenue multiple, which we can find by dividing valuation by revenue, there is an EBITDA multiple, which we get by dividing valuation by EBITDA. There is a PAT multiple, a profit multiple, that we find by dividing valuation by profit. Why is it that in startups, revenue multiple is famous? And why is it that profit multiple is not that used while valuing startups? The only reason why so much focus is on the revenue and not profits when it comes to startups is, in the initial few years, your startup may not be profitable, or in the initial few years, your startup is deploying their profits or upfronting costs for growth, because of which your profit margins are smaller, or what we call is that you have not reached steady state profit yet. So if you have not reached steady state profit yet, or if you are not profitable, you are loss making, does that mean that you don't have valuation? Does that mean that your startup cannot be valued? Does that mean that you will not be able to raise a round of funding? That is not true. And therefore, guys, revenue multiple becomes a very important benchmark when it comes to valuing startups. As the business grows, once a startup becomes an SME, MSME, etc., you get valued on the basis of EBITDA or operating profits. And as you become a listed company, people check your PE ratio. You would have heard of this in stock markets, PE ratio. PE ratio is nothing but profit multiple, right? Because at that level, companies have reached a steady state profit, and at that level, profit can be used to value companies. Therefore, guys, our focus always when it comes to valuing businesses at an early stage is revenue multiple. And how do we find revenue multiple? Please make a note of this. Revenue multiple equal to valuation divided by the next year revenue of the business. That is how you calculate the revenue multiple. In front of you on the Excel, we have calculated the revenue multiple. So if you divide 6.6 by 8.4, you get 0.8. You divide 16.5 by 12.5, you get 1.3. And that is what we have found out for a set of companies, right? Revenue multiple is what we have found out for each of this company, right? What I'm going to do is I'm going to take you to the next step. And that next step, guys, the fourth step was finding the revenue multiple, which we have actually already done. And revenue multiple is valuation divided by next year revenue. Now let's go for the fifth step. And it's a very simple step, right? If you have 4 or 5 numbers, and if you have to find one number out of it, what you do is you just do simple average. All that you need to do is you just take a simple average. When it comes to real life businesses, we actually take a median and not a mean, because there is a difference between mean and median. But right now, let's, for example, we've taken an average. You can just take a simple average. And what you have found out, guys, that you have found out the industry average revenue multiple. What we have found out here is you can now precisely say that, you know what, deals in men's grooming business in India typically happen at a 2 times revenue multiple. And guys, every set of comparables, every set of industry, every set of sector will have a benchmark revenue multiple. For example, EdTech in India possibly would be valued at 8 times revenue. Health tech in India possibly would be valued at 12 times revenue. FMCG startups valued at 2 times revenue. And extra e-commerce today possibly valued at 1.5 times of their gross merchandise value, right? So these are the matrix, guys, that the industry uses. These are the things, and these are very specific to your set of comparables. We are not talking about overall FMCG. We are drilling down to men's grooming segment and what are the revenue multiples in these set of segments, right? So guys, in step 5, what we have actually done is we have actually found out the average revenue multiple for men's grooming segment. And that is coming out to be 2 times, right? Average revenue multiple in men's grooming segment at this point in time is 2x, right? So what we have to do now, guys, is I told you, right? As a part, the final step, the 6th step, what I told you at the beginning, we are going to study a set of businesses which are similar to us, or a set of business models that are similar to us. We are going to draw certain inferences by studying the valuation and apply that inference on our company. We have studied 4 comparables of Terraman. We studied their valuation. We drew an inference which says that revenue multiple for men's grooming business is 2 times. And now, guys, we are going to apply this inference on our business to find out the valuation of Terraman. So the last step, guys, look at this equation again. Revenue multiple equal to valuation divided by next year revenue. Which means what? 2 times, start replacing one, I would say variable in that equation. So 2x, which we've just found out, equal to valuation divided by next year revenue. Think of Terraman now. Do you know how much revenue will Terraman make? What is it that they are projecting? What is it that they are saying that they will make if they raise 3 crores of funding? And this is vetted by the investors. What is the number that they are saying we will make? They are saying that we will make 10 crores of funding if you raise 3 crores of capital, right? Now, what I've done is I've just replaced this 10 crore in next year revenue. So 2x equal to valuation divided by 10 crores, which means, guys, what we are precisely saying is, as per transaction comparable method, if we look at similar funded businesses which are valued, the market says that Terraman should be somewhere valued at 20 crores. As per the market data, as per the deals, as per what activity has been happening, Terraman should be somewhere valued at 20 crores, right? I'm sure you're going to have a lot of questions, guys. Just hold on. I'm going to just address each and every question, but just hold on for a bit. Let's just complete this and let's look at what we have actually done, right? Now, how much stake should we be giving to Lion Capital? How much stake should Lion Capital be actually taking from Terraman? Again, go back to cross multiplication. Again, go back to fourth grade cross multiplication. If 20 crores means 100%, 3 crores would mean how much? And if you do that simple cross multiplication, what you will see is the stake that you need to actually offer to the investor is 15%. Now, come back to our example. What was it that Rohan and John were comfortable with? They were comfortable with a 30 crore valuation. 3 crores ke liye 10%. But Lion Capital has done their homework, and Lion Capital is saying that the valuation of the business should be somewhere around 20 crores. And therefore, what we need is a 15% stake in the business. And this is where we stand. And this is where we will sit across the table and discuss valuations. The problem with the founders is that they don't understand any method of valuation. When they go and talk to investors that I need to raise capital, and when the investor asks that, okay, so what are you valuing your startup at? They say that, hey, you know what, I think my startup should be valued at 20 crores. So the investor asks, okay, what is the basis of that? No, that is something which I find I'm comfortable with. Now that, come on guys, that cannot be your answer, right? What separates people who raise money from those who can't is capability and understanding of capital raising process. And that is precisely what we are doing right now. I'm going to just have a look at the chat window. There are a lot of questions which are there at this point in time. But let me tell you guys, what is, or let me ask a question to you. Yes, someone asked that, is this what we call as post-money valuation? Yes, this is what we call as post-money valuation. Don't get into the jargon of pre-money, post-money, etc. Just imagine 100% value of the company is post-money. I'm gonna actually take up questions. But before that, I want to ask one question to all of you. Do you see a flaw in this method? Because there is a major flaw in this method. And I want you guys to identify the flaw in this method by looking at this particular equation. What do you think is the flaw in the method? What do you think is the biggest flaw in the method? Year of deal, impacting parameters, how to validate. So perfect. So there is one, yes, Anil sir has also mentioned it right, assumption. Perfect. You guys are bang on. The biggest flaw in this method, like what Mr. Anil Goel is saying, that we can tomorrow project 20 crores. Does that mean our valuation will become 40 crores? Because that 10 crore is pulled out of thin air. It is a number which is on Excel. It is a number which is precisely on the Excel sheet which a founder has created by considering certain assumptions. Now, what if those assumptions are wrong? What if those assumptions are not validated? Obviously, the investor will look at the Excel, will validate, will put a discount to the numbers. But there is no guarantee that what is shown on the Excel will be achieved. Are you understanding? Everyone, whoever is looking at this, this is precisely what the biggest flaw in this method is. We are basing our valuation. The entire valuation is based on something, on a number which is pulled out of thin air. And guys, valuation cannot be dependent on a number pulled out of thin air. What we studied right now, guys, is a base session for actually understanding how deals are done in real life, and to pull out the uncertainty of this whole dependency on a number which is on Excel sheet, because investors are definitely not going to agree to this, right? Tomorrow you will project a revenue of 50 crores, and does that mean the valuation would become 100 crores? No. How do we take out the dependency of valuation on this projected revenue number? And this is where we are going to go into the next step of closing a round of transaction or actually identifying valuation, is by doing something which we call as deal structuring. So there are various deal structures such as convertibles, safe notes, CCPS, CCDs like I spoke about, which are used. And this is how actually a deal is done. To to close and to remove the uncertainty and to actually agree on valuation. Now, structuring a deal and continuation of this session is actually going to happen in the upcoming session, right? And that upcoming session is going to happen on coming Friday. So every Tuesday and Friday, we meet from 9:30 to 10:30. So today we have finished half our story. You have understood the base of how companies are getting valued using a method called transaction comparable method. But actually how a deal is done, you need to understand, you need to figure out, and you need to focus on various deal structures. And it is so exciting and it is so wonderful. And as a startup founder, you need to know this. And this is what, guys, is important for raising a round of funding. It is not, that you just make a pitch book and it's done and you meet an investor and people will invest. No, these are the kind of things that you need to identify and understand. And that is why only a few businesses are able to raise money, whereas rest, even though they have great business models, they are not able to raise capital because they don't understand the capital raising process. So guys, on your chat window, what we have done is, for the next session, we have sent you a link. And this session, you can register by actually, registering on that link. We have limited sign-ups for next week. So coming week, Friday, on Friday, September 4th, 9:30 to 10:30, we are having a session on how do we value a business and how do we do deal structuring. Today, we understood the method of valuation, but that method is, only 50% done, because we have to still remove the dependency of that future revenue from, the valuation, and find out the valuation of your company. And that is precisely what we are going to actually look at, right? So before I explain one more important concept, and before I, take up your individual questions and guide you, I really want to thank all our partners who play a very critical role in bringing this session to you, and being our partners for outreach. This session by FundEnable Toolkit is done in association with the institutes that you see, top-notch institutes such as COEP, IIT Kanpur, GITO, AIC Pinnacle. Thank you so much. GinServe, thank you so much. Special thanks to AIC Pinnacle. This is what we actually helps us in bringing quality content to you. If you are a founder looking to raise a round of funding and to get things such as comparable metrics, to understand each and every step of raising capital, we have created a technology toolkit for you, which is a DIY toolkit to assist you in raising a round of funding. Including this session and 12 more sessions like this, talking about capital raising, are on the FundEnable Toolkit through a 12 course, 16 hours of online module. The online modules are not, that's not it. You will require certain tools and templates to raise a round of capital on your own. For example, you will need, Excel projections. Now, you don't have to create that from scratch. We will teach you, we will provide you templates, you just have to modify them. Second, valuations. You need benchmarks, right? Why pay databases? Why go on ROC? FundEnable, all of this is available. Term sheets, preparation for due diligence, shareholders agreement, all of this is available on FundEnable Toolkit, right? So what you have to just do is, including today's session and including topics like how to list your startup, how to create an ESOP policy, along with tools and templates. So what is most important is, only session, guys, is not enough. You will be provided with documents which are easy to use, templates which are easy to use, calculators which are easy to use. You just have to feed in data and your output will be there, including the investor matrix. We precisely tell you, if you are in a particular sector, which is the right set of investor that you can reach out to. So all the steps in capital raising are available to you at a cost which you will be surprised to know. 1 year subscription to FundEnable Toolkit comes at 5,000 rupees plus GST for the entire year. For entire, you don't, once you have FundEnable Toolkit, you don't have to go to anyone else to raise a round of funding. This is enough to assist you in capital raising. Today, we are offering you a 20% discount on this. So if you buy FundEnable Toolkit in the next 2 hours, you will get a discount of 20%. Please use the discount code IAVC, Indian Academy of Venture Capital का short form, IAVC 20, to actually buy, get discount, right? So two things. One is you can go to, you can attend our next coming Friday's webinar on deal structuring. We've sent the registration link. You can get all of it along with tools and templates on FundEnable Toolkit. We have given registration link for you. And finally, guys, if you want a report on valuation by our experts, do reach out to us. We are giving you a form. You can click on the form, do reach out to us, and our team will then handhold you to give you a valuation matrix report. It's a standard report that we prepare, which will have all the comparables, all the data. We will take certain inputs from you, and we will give you a report saying that, while capital raising, you can be valued at this, and this is how you justify that valuation. So do reach out to us in case you actually are looking at valuation assistance on a person-to-person basis. Otherwise, happy to access FundEnable Toolkit. It comes at a very, very cheap cost. We do this only to assist founders in helping them in raising a round of capital. So what I'm going to do now is I'm going to start taking, I'm going to give 2 minutes of brief silence to actually look at this in terms of, actually seeing or your questions, going through your questions. And once we go through your questions, I'm going to answer each question one by one. And then later you guys can fill in a feedback form as well. It's appearing on the screen that overall, were you able to understand the topic? Overall, how did you find this session? Please give us, the feedback, right? So let me quickly go through the questions one by one, guys. And the first question is that how to find valuation of startup with mobile application. Guys, again, now any company, any company, whether it is an app company, an AI startup, a health tech startup, the same method, guys, you have to use, transaction comparable method, to kind of value your startup, right? What is the average fee on ROC? Some ROC takes some 100 rupee per download, per filing. So that's the average fee of ROC. It is very cheap, but once you download the reports, it is very difficult to understand. It becomes very, you have to actually dig deeper into each company to kind of find that. But average 100, 200 rupees, you get it. What if my startup is not making any revenue? How do I value my business? This is a very important question. And this is a question which I get almost every time when I take up valuation session. How do we value startups which are not making revenue? And that is where we are going to, in the next session, we are going to talk about structures. And one structure is used to value startups which are not yet making revenue. It's a convertible structure. So in brief, if I have to tell you, of course, there are Excel calculations, etc., which we will see in the next sessions. But in brief, what we are doing in this is we are postponing the valuation. We are taking money, but we are postponing the valuation to a certain event. which is either next round of funding or next year, etc. And we are going to postpone the valuation till trigger of that event. So you might not be making revenue today. You can raise money, but what we are going to agree on certain things. We are going to agree on certain parameters. We are going to wait for a specific time period. On trigger of specific time period or a specific event, we are going to convert the money which we have raised into equity at a certain valuation. So typically in startups, convertible structures are used, which are very famous. And that is how you value a startup which is not making revenue as we speak, but wants to still raise a round of funding. Um, how are we finding valuation just on the basis of reference companies? Again, a very, very important question, guys. Just look at this. What about metrics like team experience, quality of founders? If we see right now, we just decided the valuation basis, the numbers. But what if I say that, what? My team is much more experienced than all these four startups put together. This is where, guys, this is where negotiations come into picture. And this is where we say, hey, you know what? According to the market, my company is getting valued at 20 crores. But I am adding a 10% premium because my team is much better or because my product is much better. Now the investor will counter that. Investor will say, hey, you know what? We don't agree with this. We feel that your team is, pretty much similar. In fact, those guys are coming from IITs of the world, and you guys are, pretty experienced, but that pedigree is not there. So we don't agree. And this is where negotiations come into picture. The softer aspects such as team, quality of product, size of the market, unfortunately, cannot be captured in valuation purely on the number basis. We cannot put it in a formula. But on the base value that we are getting, we can definitely add a premium. Typically, everything put together, the premium cannot go beyond 20 to 25%. That's the standard. We have seen all of these investors have agreed and said that, what, great, but the maximum premium on the market or the value that we are getting basis market comparables, we will add only this much premium. And that is what we have actually seen, right? What if we need money for MVP and generate revenues after 3 years? How do we value such companies? As I said, I've already answered this question. We use a convertible structure. Log into our next session. Also, guys, we have a very interesting session which happened last week, and then which is going to again happen, is that how do we leverage incubation centers, especially for MVP stage and prototyping stage. Incubators are investing in companies through a fund called Nidhi SSS Fund, which is given to the incubators by Department of Science and Technology. It is actually a very good tool, and we have a full course on that. It's a part of FundEnable toolkit as well. That how do we actually leverage incubation centers to raise a round of funding? Because if you are a company which is from idea to proof of concept stage, that is the time when you should actually go to an incubation center, get incubated, and raise a round of funding from an incubation center. The Man company had a far lesser valuation, has a valuation far lesser than Beardo just a year later. How does that happen? Again, the difference in the valuation between two similar companies is because of softer aspects such as team, market size, etc. There is no technically mathematical way to capture it. That is what it is, right? How does an intellectual property affect valuation? This is also a question that I have received almost every time. How does an intellectual, it positively impacts valuation only and only if it is going to generate revenue. There are a lot of patents, there are a lot of IPs lying with startups which are non-monetizable, which means what? I have an IP for the sake of IP. See, guys, we are not in an R&D business. We are in actually P&L business, which means what? Whatever innovation, whatever technology we are building, If you are not able to monetize that, if you are not able to actually make money out of it, if you are not able to convert that product into PNL, then no kind of intellectual property is useful, right? You might have an IP for flying cars today, but today and in the next 5 years, people don't believe that they will be buying flying cars, and your revenue is zero continuously for years to come. Then what is the use of that IP from a business perspective? And that is why, guys, monetizable intellectual property positively impacts valuation, and that gets captured in your revenue. So, in a way, your IP will give you a competitive edge that will translate into higher revenue, and that will get captured in your valuation. Um, while projecting revenue, is it best to do it basis competition benchmarking? No. While projecting revenue, so we have a full modules and templates on projections on FundEnable. Um, uh, the best way is to have your own set of assumptions, looking at your business and some operating history. Basis that you actually do your projections, right? So I think that is it. We have already crossed the time limit. My sincere apologies. We are 8 minutes above the time of 9:30 to 10:30. It was an absolute pleasure, guys, to interact with you today. Thank you so much. Our endeavor at FundEnable and at Indian Academy of Venture Capital is to actually build capability on capital raising and assist you in raising a round of funding through the toolkit. We also provide various keep conducting various topics webinars. Please we will reach out to you every Tuesday and every Friday 9:30 to 10:30. We have a session on a topic which is of interest to the business owners and founder ecosystem. Next week we will meet on Friday. This week on Friday we will meet on continuing our discussion of valuation, on taking it to the next level on deal structurings. Till then, do visit FundEnable Toolkit, do have a look at it, do reach out to us with any questions that you have. Stay connected. Thank you so much. Good night. Take care. Bye.